Welcome back, everyone. This week, I thought I would tell you why it is that I'm involved in the cannabis industry. After all these years, things have gotten bad enough that they're starting to look good. If you're interested in reading this or my other works, you can, in the description box of this video, click the link. It'll take you over to this site. You can click on the internal links, which are often the case with many of my articles, and just view, browse, and recognize that this is a reader-supported publication. And if you want to receive new posts and support my work, consider becoming a free or paid subscriber. With that out of the way, let's get in this. I've been watching this industry for years. And for years, stock investors have been calling for change in this industry. And things have changed. Multiple players have been zeroed out, both investors and companies. Shares outstanding have exploded. Companies have been laden with debt, and flower prices have dropped precipitously. And the investors have also mostly done well. Of course, I should clarify that. By investors, I mean the C-suite executives, preferred equity, and debt issuers. Why am I just now getting involved? And disclaimer, at the bottom of this post, I put a little PS statement, but I'll give it to you now, which is, I started writing this when I started getting involved in the space, but I thought it was a better use of my time to start investigating the space deeper as opposed to writing out why I'm looking at the space. So it just seemed like a better use of my time, you know? So why am I getting involved now? Sentiment has largely washed out. For instance, podcast hosts, instead of calling blindly to buy pot stocks, were saying that you should only buy if there's a recession, and to do so in small quantities at a slow pace. That's a much different tune than the years before. As a side note as well, I would say that, I'll just quickly say this, about once a year, ever since 2018, at the beginning of the year, I investigate this space, kind of see what's gone and occurred over the last year and determine if I want to get involved, see the valuations the company's trading at, so on and so forth, spend a week or two on that, and then each year I've moved on and said whatever. It was in the beginning of 2023 that I looked at it and actually thought about taking some positions. I did. I got quickly stopped out. They were tiny positions, but it was the first time that I really even participated in the sector. Now, I didn't really participate, but it was the first time that I thought it was even worth my while. So then 2024 comes around, I look at again my annual refresher on what's occurred in the industry over the last year, and it seemed like things were bottoming out both in chart pattern terminology, but also in the industry come early to mid 2023. And I missed the initial 50% to 200% move that many of these companies had as a consequence. But that's what happens when you only look at something once a year for a week or two. But I digress. Valuation metrics, after all this time, have finally come down. After all of this time, they have finally come down to a quote-unquote reasonable level, which is really to say that they're not asininely expensive. Then you have the growth at any cost, what I call GAC, has largely stopped. CapEx spend fell off a cliff, and companies are now focusing more on repairing their balance sheets rather than growing their unprofitability. The marginal cost of production is below the selling price, more so because of company bloat and inefficiencies in operations, but hey, it's still the case. It's when the mines get shuttered and commodity prices are in the toilet that you want to look at investing in a sector. Also, capital is harder to come by in this space. To sum it up, washed out sentiment in a bombed out sector, not sky high valuations, management teams are more focused on the balance sheet and cash flow than the income statement. Although top line isn't doing well, the internals are improving or deteriorating less rapidly, and capital has largely left the sector. These are the sort of things I look for as someone who loosely considers themselves a cyclical commodity speculator/investor. I should also mention that I'm only getting involved in a very few select names. playing it safe. If you're betting on federal litigation, then you're probably taking more risk. After all, why wouldn't you? If that's where your focus is, then your concern with business health is at best a secondary thought. The most desperate and leveraged players are the ones who will benefit the most. The highest cost producers are the ones who are geared the most towards the upside in a commodity bull market. Except in this case, it's more along the lines of a legislative and legal bull market, which is being anticipated. And that's definitely a game to play. However, that's not the game I'm interested in. Participating in a bombed out sector itself affords enough potential upside. For me, there's no need to layer on risks. It's risky enough as is. I'm trying to find competent management teams who are the lowest quartile cost producers. This sector as a whole is risky enough. Most of these companies have enough operating leverage as it is. I needed to go any further out into the risk curve by betting on quasi-competent management teams whose game plan has been to bum rush in the states in an attempt to establish pseudo-oligopolies via regulatory capture, yet still manage to incinerate millions of dollars in the process. This preoccupation with maximum upside is predicated on things changing. But guess what? These companies have to manage not going into receivership first before they're able to capitalize on any potential future catalysts. A recent example of a company that failed to bide their time until regulation benefited them is MedMen. Rarely is there discussion on downside risk among sector participants. Instead, the conversations are saturated with how well varying companies will do with regulatory change. I want to know that if this sector doesn't see any legislative catalysts in the near future, that the names I'm involved in will make it through. And not just make it through, but be able to use their competitors' weakened state to their advantage by taking market share or consolidating the industry. I'm not focused on the half-decade plus long pipe dream of tomorrow. I'm focused on the guarantee of the past, which is to say management's team's track record, which is in large part has been abysmal and unblemished by success. That's the narrative I care about. The one of management's track record. Not all this hoopla that's among the mainstream outlets. Why not other MSOs? Quote, there's Curaleaf International. Don't you want to be a part of that? End quote. My presupposition going into this is that I don't care about catalysts. Catalysts is another term for the narrative of the promise of tomorrow. I'm purposefully keeping my expectations low. I'm extrapolating present and recent occurrences in this industry and projecting that forward. I'm well aware that that's a dangerous game, but it also provides a margin of safety. You can't justify buying expensive stocks that's been trading poorly if you remove the promise of tomorrow. This strategy will also ensure that I don't maximize gains in the future. No solution is without its own setbacks. My bet is on things normalizing and not deteriorating any further. That's my base case. The fact that I'm even involved in this sector is one of implicit optimism. My focus is on the downside risk. I'm trying to discount the narrative as much as possible without completely being blind to it. Most people need the narrative to justify these stocks' prices. I don't. I'd rather just gravitate towards the stocks, which, and by stocks I really should say companies, which don't need enthusiasm, yet elicit enthusiasm based upon their business practices and developments. Arithmetic is what gets me excited. I'm adopting such phrases and expressions as, the past is prologue. The past is the best predictor of the future. History doesn't rhyme, but it often repeats. Now, you could say that most people in this space are putting forth these sorts of expressions. There are decades where nothing happens, and there are weeks when decades happen, or gradually and then suddenly. But may I remind you of the irony of that second quote, since it pertains to bankruptcy. I want the cleanest balance sheets, cash flows, low interest-bearing debt, and things like that. I'm trying to make a safe bet, or more accurately, a less dangerous bet. I'm not interested in this infinite horizon and evergreen story that people have been pushing for over half a decade. It will come, but I'm not counting on it. And even if I am counting on it, that is an interesting use of the phrase, don't you think? Because I can assure you that most people don't really have any arithmetic on how they are counting on it. We all know of Nassim Taleb's Thanksgiving turkey and their error in assuming that things stay the same. I'm trying to not be a turkey, both in the context of being a dud or a loser, as well as not being someone else's dinner. My default baseline is to be skeptical of others and presume they're out for their own self-interest and for nefarious reasons. You need not look any further than an investor presentation to see how biased and partial management teams are. Oftentimes, it isn't that they're lying, it's that they're selectively framing facts while conveniently obscuring, obfuscating, and ignoring unflattering facts. The more novel and new an industry, the more true this is. The asinine and ludicrous projections that some of these companies made a few years back is frightening. But hey, this isn't a management-only problem. This is a human problem. I've never gone on a date and had a woman tell me why I shouldn't be with her, only why I should be with her. It's more along the lines of me needing to do my own due diligence. Seemingly, people don't feel obligated to tell you anything that's unflattering. And yes, these are the same people who will look you in the eyes and tell you that they believe that people should tell the truth, the whole truth, and nothing but the truth. And that honesty is the best policy. Quite an interesting divergence and contradiction between their speech and behavior, don't you think? But I digress. The point is that you need to come to the investing game with these realizations of the human condition, and if anything, that these are professional, top-notch spin artists. Most people are rather transparent in their unsophisticated, low-level coercive tactics. Management teams are consummate professionals at it. Remember that turkey from earlier that I referenced? It thanked the people for protecting him and taking care of him. And the whole time, ulterior motives were at play. Do you not think that the same holds true for management teams? Let's take into consideration the phrase adjusted EBITDA. Is that not being used with an ulterior motive by your handler, management team? A proper gaslighting of investors to not only tolerate it, but to standardize it due to its repetitive use, and you and the generations after you become increasingly desensitized, habituated, and normalized and accepting of it as a baseline reporting practice. And then before you know it, management's compensation packages are based upon it. Well played, management teams. Well played. I'm investing with the following attitude. The absence of bad is good. The slowing deterioration of things is good. The leveling off of precipitous declines is good, whether that be flower prices or the basing formation that many of these stocks have created since their late 2022 end-of-year dump. Washed out sentiment in a bombed out sector is normally where I do my stock shopping at. Seemingly though, even after a gut-wrenching 5 years, the true believers remain. So will sentiment ever wash out like I normally like? I don't know. Charts like this pique my interest. This is, I believe, Michigan's flower prices. Might we be, link is in this article. So if you want to make sure that is Michigan, then click on that link. Might we be at a new normal, a lower plateau? Is it sustainable? Is the cure for lower prices lower prices? In conclusion, I'm a big ship that doesn't turn on a dime. That's my personality, whether I like it or not. Therefore, I can't invest in something that requires me to stay up to date on every new industry detail. The funny thing is, that's why so many people like this sector. It gets their feelings engaged. I stay in my lane for the most part with hard assets and old economy type businesses. Things are established and everyone knows what to expect, for the most part. This is all to say that I'm already out of my comfort zone participating in the sector. Things are anything but settled in the cannabis industry. It doesn't seem obvious to me that the current Tier 1 MSOs will still be the Tier 1 MSOs in a decade's time. A lot of crazy things can happen in a decade. I imagine one will run itself into the ground, perhaps another one will get gobbled up in a M&A, another one will get bought out by some big alcohol, pharmaceutical, tobacco company, and the list of pure plays will slowly dwindle. I suspect some will forgo being vertically integrated and instead become more of a branding retail play that merely buys their product wholesale. How many hops producers are you aware of in the alcohol industry? How many grape growers are you aware of in the wine industry? For those counting, that's 5 Tier 1 MSOs turning into 2. I'm sure that federal litigation developing will shake things up and some smaller, more regional players will zoom ahead in this game. New solutions will create new problems. For instance, what are the implications of interstate commerce? What about the moats that have been created from regulation that bans interstate commerce? We might come to find out that the banning of interstate commerce was their primary tactical advantage. There's a tactical benefit to the 280E staying in place too. It allows the players who are benefiting from it to get bigger and stronger while the weaker players get absorbed and strangled. Intrastate commerce plus limited license states plus 280E has allowed for the financially backed large players to establish a pseudo-oligopoly due to regulatory capture. There's a reason why Apple, Microsoft, Meta, and Google like regulation. It creates an artificial barrier to entry. And guess what? The big MSO players might be getting hurt by regulation, but they're also in a very real way benefiting from the regulation. Limited licenses help minimize competition, for instance. And we've seen how brutal things are even with the limited license. To even ask a question like, what's the downside for rescheduling? People will look at you dumbfounded. And it gives me PTSD back to 2018 when I asked a similar group of people, both in spirit and intellect, what the downside for cannabis back then was. And I got the same look. It gives me the chills. Let's not forget that this is a game of brands. The longer these artificial barriers can stay in place, the more loyalty, dedication, and rapport the customers have with the product. You might see a real bifurcation last for years after the lifting of and allowing of interstate commerce, and it will be a slow and incremental shift of consumers to different brands, only to find out that any particular company of choice had loyal customers only as a consequence of the lack of optionality that the customer had. This is a problem with the consumer packaged good industry in general. Do you buy generic? Do you buy some West Coast bud? Or if you're a Floridian, do you just stick with the ones that you've known and have used that are time tested, such as True Leaf? Do you not think that when regulation loosens up, that we won't see billions upon billions of dollars flood into this market again? We saw the drama and trauma that created last time. I suspect this might be on a grander scale. Do we get a 2.0 rendition and rinse and repeat of the last time when capital poured in? And will that lead to another lost half-decade for stock investors? Why not? Executives get paid on adjusted EBITDA and revenue figures, meaning that they don't need to run a profitable business, especially when money is easy to come by. Matter of fact, they're perversely incentivized to make horrible mergers and acquisition deals in order to grow their adjusted EBITDA and revenue. And we know that they'll do that because they've done it before. These are but a few questions I have, and my positioning in the names that I own are my answers to these questions. As time goes on, I expect these questions to be answered. P.S. This piece should have come out a couple of months ago, but I thought it'd be a better use of my time to dive deeper into this industry and its actors than solidifying my thoughts on why I was looking at the industry to begin with. And that is it. Thank you for watching. And don't forget, Cup of Coffee Capital is a reader-supported publication. To receive new posts and support my work, consider becoming a free or paid subscriber. Thank you, and until next time.